So, you know that a dividend is a payment made by a company to its shareholders. But what do we mean when we refer to the dividend yield? Well, it's actually fairly simple and a key measure for those that look to dividend stocks as a means of obtaining passive income. The dividend yield is an estimate of the level of dividend return of a stock. It is simply the annual dividends per share divided by the price per share. So, suppose the stock pays out dividends every quarter. You simply need to add up the dividend payments per share made during the last 12 months and divide by the current stock price. For example, suppose the stock pays out a quarterly dividend of $1 per share and has a price of $150. The annual dividend would be $4 divided by $150, which, when expressed as a percentage, is 2.67%. That is, the stock has a dividend yield or return of 2.67%. It's important to realise, however, that the number you get is only an estimate, and it will heavily depend on the accuracy of your dividend data. This is because dividends change over time, and what was paid in the last 12 months won't necessarily be paid in the next. It's also important to understand that dividends are never guaranteed, and that a fall in stock price can actually increase the dividend yield. This is all because there's an inverse or opposite relationship between dividend yields and stock prices. This can create a kind of mirage for investors to believe that a stock has great dividend returns, when in fact, all that's happened is that the company's stock price has fallen due to, for example, financial mismanagement or a scandal. In the former situation, the likelihood would be for the company to hit the rocks, and possibly for dividend payments to cease entirely. In the latter, at the very least, the value of the stock would take a hit, and you may end up suffering a loss should you decide to sell. Beware dividend yields that are unusually high, as they might just be traps for unwitting investors, precipitated by the falling stock price of a financially distressed company. Always consider the stability of the underlying company and the level of risk in continuing to hold the stock. This is why dividend investors opt for large cap value stocks with a good track record of dividend payments, rather than the more exciting but ultimately riskier growth stocks. Overall, it is therefore clear that investors should always consider all of the available data when evaluating any given stock. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.